Welcome to the Art of Investing, a new video series designed for busy investors like you to teach you how to make money work for you. This series will be shaped based on your feedbacks, but I will follow a structured framework to build a strong foundation of the knowledge here. Today we will begin with an overview of some of popular investments opportunities that we will see. Let's start. Okay. Now we have set the stage, let's explore some of the most popular avenue where individuals like you put their money to work. We will touch on the basics of each, giving you a foundational understanding of what they are and how they work and what are their returns. First, let's look at a real estate investment, which is all about owning physical property. You can make money from renting the property or by selling it later in a higher price. The property could be a residential property, commercial property, lands, or even REITs or real estate investment trust. These are the companies who own properties and trade on the stock market. This lets you invest without directly buying a property. While the real estate can offer steady income and long-term growth, it often requires a lot of money at the start, and it's not easy to sell as quickly as other investments. The chart here that I show in this picture, you can see the value of real estate in increasing over the time in the United States. This is the average value in the whole United States. Based on the long-term data, real estate has an average growth of the value of 4.2% per year. This number shows the average yearly return on the investment from the property, and it's called appreciation. It includes all the short-term up and downs, and it could be different in places, but mostly kind of like the range is 4.2% as we see here. Let's go to real example here. Walk through a long-term real estate investment to see how leveraging your money can boost your return here. Imagine you buy a house for the median price at this time 400K. We will assume the property value increase 4.2% per year. After 20 years, we consider the long-term investment. After 20 years, it's going to be 9-10K. When you sell the property, you will pay for some transaction fees, let's say 3% or 27K. Most people don't buy the house with all the cash value. They pay down payment. Let's assume 20% of the down payment, some like a regular down payment at this time, which is going to be $80,000. This is your initial investment. The rest is covered by the tenants and the payments on the rental. A key benefits of real estate is the rental income from tenants can cover all the mortgage payments, essentially paying down your debt for you. So after 20 years, you will sell the house for 9-10K. You have paid the initial investment of 80K. Since the tenants pay the whole mortgage, then your final gain is 80K, $880,000. This means your initial $80,000 will grow to $880,000 in 20 years. Using a compound annual growth rate, this means it's going to be 12.5% yearly return. This powerful return is as a result of leveraging as a down payment that you had, where a small amount of your money you put at the down payment and it controls a much larger asset and the rental income covers the cost. Let's go and refine this example a little more, changing one key assumption here. What if the rental income doesn't cover all the costs here? In this scenario, instead of covering all the 12 months and every cost in the house, let's assume it covers 10 months of the year. And for the payment that we have for the mortgage, for the remaining part is $4,800 that we pay out of pocket. Even with this extra expense, your annual return is still very strong and approximately 10.5% per year. This shows real estate can still be a powerful investment. the combination of leverage and long-term appreciation still provide compelling returns on your rental investment. While real estate investment offers great returns, it's not hands-off investment. It requires active management in mainly two areas. Tenant management, you need to find tenants, screen tenants, putting lease agreements and collecting rent, and property maintenance. You need to have the property in a good shape. You need to have pay for some repairs, replacing of the roof, HVAC system, and other things that could happen to the property. There are some management companies that can handle these tasks for us, but there is a cost on that one. You need to pay 10-20% of your rental income to them to do the coveraging of these maintenances. Despite the work, the real estate is a popular choice for long-term wealth creation. This combination of property appreciation and mortgage pay down payment and cash flow can provide a significantly higher return on your initial investment. It's also push you in a long-term investment and doesn't let you cash out easily for other crabs that could happen in life. Now let's talk about bond investment. You may have seen and heard about that. Bonds are a way of lending money and get interest payment back. Here are the four key parameters in the bond that you need to consider. First, the face value is the amount of the bond that will be returned at the maturity. Coupon rate is the yearly interest rate you will receive. Coupon payment, the actual cash you get from the interest usually paid annually or twice a year. And maturity date is the date when the bond is paid back in full. It could be few months, it could be years or 10 years, 20 years. And usually when we go with the higher years, like when we go to 20, 30 years, the rate is higher. And now let's compare bonds and stocks. One of the main benefits of bonds is their predictability. You can regularly steady getting payment from the bonds, which makes them popular choice for people who need consistent income. Bonds are generally considered low risk than the stocks because its issuer promises to pay you back this interest because they are like less risky. The potential returns are also lower compared to, let's say, stocks. Let's go back to our examples of 80,000 and let's invest this in the diversified portfolio of bonds. You could expect to receive around $4,000 in interest payments each year, which is 5% yearly return at this time. You can buy bonds through banks like Fidelity, Chase, Vanguard. These institutes allows you to buy individual bonds or funds that hold many different bonds, which helps to diversify. And let's go next to stock investment. And let's talk about stock investment. It's often misunderstood, but it's important to understand that the stock investment is not gambling. Gambling relies on luck, while stock investment is based on knowledge, research. When you buy a stock, you are actually buying a small piece of that business. Your investment grows as the company grows and becomes more profitable. However, stocks don't come without any risk. There are some risks to that. First is the market risk. It could be the market goes down and changes the stock value. There are company specific risk, which is like single company performance. Like if it performs poorly, the stock price goes down. The best way to manage the risks here is diversifying your investment across many different companies and industries. This allows you to participate in the growth of companies and potentially build wealth over time. And let's insist again that stock investment is not gambling. It's about buying a small piece of company. When the company grows, your stock value increases as well. There are short-term up and down, but the long term is actually depending on the growth of the company. To track the overall market, we usually use indices. You may have heard about S&P 500, Dow Jones Industrial, Nasdaq Composite. Those are indices which including different type of companies and different type of investments. A great way to invest without picking individual stocks is buying ETFs or exchange traded funds. The ETF holds stocks, giving you instant diversifications, lower risk, and simple way to gain market exposure. The S&P has had an average yearly return about 12% over 20 years. It has been up and down areas like 2008. There was a big dropping there, and there it doesn't go straight up, but if you consider the long term, it's about 12% yearly, even with all the up and downs. This shows the power of investing for a long term. Let's wrap up here. We have explored the real estate bonds, stocks, and different investment types here. Each has a different risk profile and also potential for returns, but they all require knowledge and clear understanding of your goals here. This is just the start of our journey. In future videos, we will dive into the specific strategies, risk management, and building a portfolio that find you and your financial goals. Thank you for watching.